This brief video highlights various topics included within our 4-day blended training workshop on loan restructuring. The course provides a comprehensive understanding of essential loan restructuring concepts, tools, and techniques. The program entails 4 modules. Each module includes a remote session and e-learning activities. Participants can discuss topics and concerns during the remote instructor-led sessions, exchange thoughts, share experiences with the instructor and peers, and receive constructive feedback in a supportive environment. The remote sessions are supplemented by e-learning activities including videos, handouts, and quizzes designed to improve understanding and retention. Though the information may not be on the front pages yet, banking professionals, regulators, international financial institutions, and development finance institutions see and understand the impact of COVID-19 on the portfolios of financial institutions globally. Furthermore, as the stimulus and relief packages expire, the extent of the COVID-19 impact on the financial institution's portfolio and government budgets will become quantifiable. Seasoned lenders understand that economic turbulence and macroeconomic shocks are ongoing market occurrences which will result in financial institutions being exposed to upsurges in non-performing loans. This undeniable and unavoidable fact is particularly challenging in markets lacking a long history in problem loan management. Executives will increasingly need to rely on their management and staff to maintain and improve the financial institution's position by restructuring troubled credits now and in the future. We introduce practical tools that support lenders mandated to improve their financial institution's position by restructuring troubled credits. Core themes that run throughout the course include evaluation protocols that enable lenders to assess credit requests professionally, the importance of cash flow analysis and other practical tools to assess a borrower's ability to service debt, and loan restructuring tools that protect and preserve a financial institution's position. As mentioned, participants can discuss topics and concerns during the remote instructor-led sessions, exchange thoughts, share experiences with the instructor and peers, and receive constructive feedback in a supportive environment. The workshop reveals our experience in delivering similar courses in Asia, Europe and Central Asia, North Africa and the Middle East, North America, and Sub-Saharan Africa. At the onset of the workshop, we perform a reality check and ask the participants to begin by backing up and considering the big picture. What are we doing? What is the situation? What is the task? What is the goal? And how do we measure success? We are talking about loan restructuring because there is an existing or perceived problem or default, payment or technical. Thus, we are dealing with a troubled loan or relationship. Big picture, there is a problem or perceived problem, loan or relationship, which we are trying to correct, mitigate, or avoid. At that point, we begin discussing some essential terms and concepts to make sure we have a common understanding. The definition of problem loans is essential because it drives our actions. Also, the descriptions should facilitate and require early recognition. Therefore, we encourage lenders to consider defining problem loans as loans that are not being repaid as agreed, loans to companies with financial problems, and loans for which repayment risk has been identified. Please notice, this definition includes loans currently being repaid as agreed, but continued repayment is uncertain. We recommend lenders focus their attention on managing problem loans instead of non-performing or non-accrual loans. By focusing on problem loans, lenders are required to identify problems earlier rather than later. Accordingly, the recommended definition requires a lender to designate a loan as a problem loan even if the obligation is currently being repaid. Frequently, success in managing problem loans comes down to a matter of early recognition. The earlier a problem is identified, the easier it is to resolve it. Once a loan is designated as non-performing, or once there has been one or more payment default, the odds of full repayment decline substantially. Let's revisit the big picture questions we asked. Notably, how should success be measured? It is essential to discuss measuring success pragmatically. Otherwise, how do we know if we are doing a good job, or when to stop or continue? We pragmatically discuss the objective of problem loan management and loan restructuring. When managing problem loans, the objective is to improve the bank's position. This objective applies to large corporate, commercial, SME, and retail problem loans. How do we improve the bank's position? The answer is straightforward. We improve the bank's position by reducing exposure, principal or interest, or increasing collateral. Thus, we measure success by considering improving the bank's position. It is essential to understand that a slash and burn approach, for an example, immediately liquidating assets, may not always produce the best recovery for the lender in the long run. As assets are liquidated, the borrower's ability to generate cash in the future is also eliminated. Now let's discuss the objective of restructuring a loan. Pragmatically speaking, the objective is to enable a borrower to repay, thus enabling a non-credit-worthy borrower to be designated as credit-worthy. If we enhance or improve a borrower's ability to repay, the borrower's willingness to repay may also be enhanced. However, if and when a borrower is unwilling to repay, there is a different problem or issue to be addressed, and restructuring a loan may not be the suitable solution. Suppose a borrower does not want to repay or has no intentions of repaying. In that case, the restructuring must have targeted objectives and goals, which consider the various stages of payback discussed in the program while always striving to improve the bank's position. Thus, by restructuring, our goal is to improve a troubled borrower's ability to repay, thus enhancing the bank's position, thereby enabling the borrower to be designated as creditworthy based on the ability to repay. We present various loan restructuring tools during the workshop and provide participants with additional resources such as long reads and work aids that they can use after the training. For an example, we discuss approaches for estimating the tenor of a trade transaction, calculating the amount of a line of credit, estimating medium and long-term loan tenors, financing permanent working investment, calculating a haircut or loan write-offs, and using a cash recapture clause to enhance the probability of full repayment. When estimating the tenor of a trade transaction, we encourage our participants to use the cash conversion cycle concept to ensure adequate but not excessive financing is provided. We introduce a pragmatic approach for estimating a line of credit amount based on the company's forecasted revenues and expected sources and uses of cash during the period. The process fosters constructive discussions between the lender and the entrepreneur, which contributes to the effective resolution of a problem. Estimating the tenor of a term loan is somewhat a matter of trial and error. The loan tenor is driven by the level of debt and the borrower's debt capacity or cash flow. We emphasize that within reason, a lender can adjust the loan tenor to enhance the borrower's ability to repay, which is a central criterion for creditworthiness. However, the lender's use of this tool, loan tenor, is governed by the financial institution's policy regarding loan tenor. Whereas loan tenor enables a borrower to be classified as creditworthy, we are insistent that it is inappropriate to adjust the company's cash flow without substantiated and verified reasons. Over the years, we've noticed various financial institutions using short-term loans to finance a borrower's permanent working investment needs. The financing represents a permanent need, so cash flow is the appropriate lending rationale, not asset conversion. Correctly understanding and applying the tools enables lenders to resolve problems by effectively restructuring loans. The term haircut began to surface in financial texts around the 2007-2008 financial crises. The term denotes a reduction in the amount paid to creditors or a decrease in the face value of a troubled borrower's debt. A company in need of debt restructuring or debt relief may try to renegotiate with its lenders to take a haircut, which means a portion of the outstanding interest or principal obligations would be written off and thus not paid. Local regulations in various markets restrict the use of tools we discuss. For an example, debt write-off, debt for equity swaps, haircut, and debt subordination. Nevertheless, our training participants have expressed appreciation for being presented the information, since some of the solutions may be applied shortly. We highlight the importance of using a cash recapture clause during the course, especially in those cases that require a haircut. Doing so increases the probability of full repayment. As lenders and humans, we understand the difference between working with cooperative and uncooperative borrowers and people. We all acknowledge that cooperative borrowers are easier to work with than uncooperative borrowers. We explore procedures for selecting strategies for working with cooperative and uncooperative borrowers during the program. Two fundamental credit variables guide the approach: the borrower's viability and the collateral adequacy. Thus, the strategy used when managing the troubled borrower is based on whether the borrower is cooperative or uncooperative. Some people find the negotiation process most stimulating, and others find it to be the worst part of the job. We tell the participants, whatever their view may be, don't take it personally. Understand that negotiations are part of the process and part of the job. Consider yourself an actor with a role to play. Play your part well. Be professional and try to enjoy yourself as best you can. Since the negotiations are a critical aspect of the restructuring process, we must take it seriously, conduct ourselves professionally, which involves planning and preparation. At a minimum, the preparation required to negotiate effectively includes understanding your institution's policies, establishing your institution's objective, assessing the negotiating leverage of the various players. For an example, who has the most significant influence, the bank or the borrower? Determining the minimum acceptable terms and conditions, and establishing and stipulating the negotiator's authority to commit the lending institution to the approved terms and conditions. Thank you for viewing this video. Our goal was to outline the topics presented and the pragmatic approach used. If you want to learn more about this and other training programs offered by GBRW, do not hesitate to contact us via our website, and we will respond promptly. Our website address is www.gbrw.com. Thanks again.